Foreign companies looking to begin operations in Bangladesh or exit an existing investment must first determine a transparent and defensible valuation of the local entity. This is a critical step not only for regulatory approval but also for negotiating terms with local partners, assessing future prospects, and ensuring smooth repatriation of proceeds. We have seen this in practice when global investors evaluated Bkash during successive funding rounds and when Linde Group reassessed the value of its Bangladesh subsidiary ahead of strategic divestment decisions. These real-world transactions highlight how essential a robust valuation framework is for both market entry and exit. Bangladesh Bank's 2018 valuation framework has a structured and rationalized approach to this process, replacing broad guidance with standardized methods, clearer documentation requirements, and greater transparency. This is Tahmina Jahan, an analyst at Lion City Advisory. The guidelines incorporate clear standardized approaches. 1. Mandatory use of three valuation methods: net asset value, market value, and discounted cash flow, combined through a weighted average unless justified otherwise. The asset-based approach focuses on the company's real tangible worth by strictly following IAS or IFRS rules and excluding assets that can distort value, ensuring a solid baseline. The market approach compares the company with similar listed peers, filtering out extreme ratios and relying on audited data and one-year average market multiples for a fair market-driven price. And the income or DCF approach captures future potential but with disciplined rules, realistic cash flow forecasts, justified growth rates, and a regulated discount rate, so the valuation remains credible and defensible. Together, these methods bring transparency, consistency, and reliability to the valuation process under the new framework. 2. Bangladesh Bank approval at MOU stage. The share sale memorandum of understanding must be based on Bangladesh Bank approved fair value, not just negotiated price. 3. Clear requirements for valuers. Valuers must be licensed merchant bankers or chartered accountants listed by BSEC or Bangladesh Bank, maintain independence, and provide a fairness opinion. 4. Simplified cases without mandatory valuation report. If the transaction value is less than 10 lakh taka or net asset value exceeds deal value, Bangladesh Bank may compute fair value directly, reducing cost and time. 5. Structured document requirements. Annexure V provides a comprehensive checklist that eliminates ambiguity for stakeholders, offering predictable valuation methods that reduce disputes, faster processing through clear documentation, and a lower compliance burden by exempting small transactions from mandatory valuation. By establishing transparent, standardized rules for repatriation, it also boosts investor confidence, ultimately enabling smoother exits, easier foreign investment flows, and stronger governance. At Lion City, we provide advisory on valuation frameworks that are fully aligned with Bangladesh Bank's guidelines, integrating triangulated valuation models, net asset value, market multiples, and DCF exactly as required, while applying industry-relevant assumptions grounded in audited data and compliant WACC calculations. Our approach maintains strict independence and ethical standards consistent with Bangladesh Bank's expectations, and we complement regulatory compliance with market-informed insights to ensure valuations are not only accurate and defensible, but also commercially meaningful. By operating at the intersection of regulation and real-world market dynamics, Lion City delivers buy and sell-side transaction advisory that stand up to scrutiny and are seamlessly acceptable to Bangladesh Bank. That's all for today. Keep in touch with us for more such insights.